But sometimes they'll sit on their hands and still collect their fees. And I've seen one example of this recently while the property continues to atrophy. And the investors are basically held captive in situations
Yep.
like that.
Welcome to Investing for Generational Wealth. I'm John Lai from Clive Capital, where we help high earners just like you invest outside of the stock market to passively achieve long-term wealth generation through superior risk-adjusted returns, long-term passive income or tax flow, and passive income and tax benefits. Together with you, we're investing in over 1,000 multifamily apartments under renovations, over 500 single-family rental homes under development, more than 350,000 square foot of industrial rental real estate, and then 700,000 of private loans. And we've expanded into other asset classes, such as oil and gas ventures and others, with the end goal of helping our investors, you, create a diversified, balanced portfolio. Before we begin, a disclaimer, we are not financial advisors. All investments are subject to risk, including the possible loss of the money you invest, so please perform your due diligence before making any financial decisions. And of course, consult your CPA and your attorney before beginning investments. Again, I'm your host, John Lai, and welcome to today's episode, Hidden Fees and Precautions for Syndication Investors with Richard Crouch. Richard is a principal at Woods Rogers and chair of the firm's business group. He has over 2 decades of experience in commercial real estate law. And in this session, I'm really excited to hear Richard will unpack the often overlooked hidden fees, pitfalls, and legal considerations that syndication investors need to know. This session will help you navigate agreements with confidence and avoid some costly mistakes. We'll cover things like common hidden fees that erode investor returns, legal red flags to watch out for in syndication documents, best practices for protecting yourself in real estate syndications. For those who don't know your journey, Richard, could you give our audience a brief history of how you got to where you are today?
Certainly. I've been practicing in this area, commercial real estate law and business formation for about 24 years. And actually, the firm I'm currently at is the only firm I've ever worked at, which is kind of rare, but they hired me right out of law school. And I had two excellent mentors in that journey. The first of which was great about teaching me all the technical skills and what to look for, what to not miss in your review. And the other attorney who I talk to very often and pretty much use things that he taught me every single day, taught me everything else that they don't teach you in law school, just about client engagement, managing clients, retaining clients, and attracting clients, and answering your clients' questions, not wasting their time, and was very forthright about imposing the mindset that time kills deals. And so that you have to be incredibly organized, responsive, you have to add value, and so on. So that particular mentor is now teaching yoga in South Beach. He has transitioned on to better things. But again, I'm eternally grateful to him. And like I said, use what he taught me every day. We do practice everything you would anticipate in terms of commercial real estate, from acquisitions to dispositions to refis, 1031s, as well as all of the private placement documentation in connection with syndications that you would expect. And we do commercial leasing and environmental law and pretty much anything that could impact your real estate transaction are things that we practice. So that's generally my history. So about 24 years, and I've been doing the same thing that entire time and enjoy working on deals.
Thank you for the background. What first drew you to this area of commercial real estate, and how have you seen the landscape change for syndication investors, maybe more recently rather than over the 24 years, which is a long time span?
Yeah. I was interested in general business law, and at the time I started, it was in the early 2000s. So I think 2002 is when I started technically. And at that time, real estate was very, very hot. It was really the upswing of the bubble before the great financial crisis. So definitely saw a lot that happened there. Saw the challenges in emerging from the GFC, and am now seeing some of the challenges of the increased interest rate environment that we're seeing now. So different fundamentals, different issues at play, but it is clearly the largest slowdown in transactional volume that I've seen since probably about 2009, 2010 timeframe after the GFC. So some of the things that I have seen that have changed in that time frame as it relates to syndication is when we were first doing syndications, believe it or not, they were for retail deals, and shopping center syndications in the early 2000s were very hot. And that tends not to really be the case much. Although we do a fair number of syndications, they're usually not in that space. They might be multifamily, they might be industrial, a little bit of office, although that's slowed down since COVID as well. But some of the things we've seen that have changed were some of the initial operating agreements that you would see back then would actually have provisions saying that there would be no capital calls in any event from any investor. And it's interesting. And that was actually more investor driven because they didn't want to be requested to pony up additional funds later on. They wanted to basically set it and forget it and not be approached later. That did create some situations where, through just creative structuring and educating the investors on those particular projects that did need additional capital, we were still able to work it out. But obviously, something that's become much more common is I really don't ever see operating agreements now that don't have some provision for capital calls. It's been particularly helpful lately because we still seem to be stuck in this extend and pretend environment, particularly for some of my clients that might be heavy in office, where there are struggles meeting certain financial covenants, or they're having issues with certain tenants that maybe had vacated. That can be challenging as well, but it's very comforting as we're dealing with these loan extensions or modifications to have provisions in the operating agreement that address what the mechanisms are for capital calls. It certainly has made the process go much more smoothly. And although these are challenging times, it's good in some ways to go through these times, much as was the case with the GFC, is you see, okay, what type of things can go wrong? And how did the language benefit us? And how can the language possibly be improved going forward? And that's something that largely you learn through experience. And I've been very blessed in 24 years, but going through two downward cycles isn't too bad. And so, in a lot, probably the bulk of what gets learned is during those windows of time. I would say one other thing, and we can elaborate on this to any degree that you like, is I have seen sponsors much more transparent about disclosing any fees that they intend on collecting. And I would say that's generally very good practice because many of these transactions are set up where the sponsor is going to be getting some sort of sweat equity piece after the preferred return gets paid. But usually there will be other fees that they intend to collect. And these can be financing fees, acquisition fees, disposition fees. And one thing that I've definitely
Mhm.
restated to them is in any of their investor materials, whether it's subscription agreements, private placement memoranda, or the operating agreement, to make sure that any of those additional fees that they plan on charging are very clearly disclosed, and so that you don't have to explain it or rationalize it later. Because it's the type of thing when things are going well, people might be a little bit, they may scrutinize it to a lesser degree, but when returns are not being met, that's going to be hard to justify something that hasn't been disclosed. And I would say one last thing that I've noticed, I mean, there are quite a few, but these are the ones that come to mind, is even if your documentation as a sponsor is pretty clear that you can collect certain fees and that you're entitled to certain fees and percentages, notwithstanding performance of the asset. Sometimes, if you're not meeting, and not just sometimes, often, if you're not meeting the returns that are contemplated in the operating agreement, even if the fiduciary duty has been waived, even if you're not technically liable for it, the optics of the situation and preservation of your reputation in the long term generally warrant you waiving or deferring your fees until your investors that have put up the money are caught up. And that's one of those things where often I advise sponsors to not be short-sighted in that regard because when it comes to something like this, your reputation is your currency. And if you want to be in the game for a long time, you need to preserve that credibility. And that might include not paying yourself if your investors are losing money. So that's one other thing I've seen more sponsors be wary of in the latter part of my career.
Yeah, that's great perspective. I always like to see that in a sponsors operator, if they are catching up investors, they pay them first rather than take the fees that are even specified in operator agreements. So that's great.
Yeah. I would say also more sponsors I've seen are willing to put their own money in the deal as well. And I think that's another thing that enhances credibility because you're not just collecting the sweat equity, you truly do have skin in the game. And that's another thing I think that gives assurance and comfort to investors.
Speaking of fees, I have a couple of questions on fees. Are there red flags in how fees are disclosed or maybe even not disclosed that investors should learn to spot early on? Let's start with that.
Yeah, I would say if you have anything that where it's maybe buried in the footnotes or a schedule, be mindful of that. I mean, technically that would still protect the sponsor, but it's if in any way it seems in their materials that they're hiding it or downplaying it, just be mindful of that.
Mhm.
I would say also if it's not specifically defined as to what that fee is for, it may have a general nomenclature where you think you know what it's for, but you just want to make sure you know how it's calculated, what the percentage is, how often that fee can be charged. Because you'll have certain recurring fees, like you might have a property manager that either could be an affiliate of the sponsor, so they'll be charging for that, but they may also be charging an asset management fee on top of that for anything the
Right.
property manager wouldn't be handling. There's nothing nefarious or wrong about that. That's pretty standard, but it's just another thing for people to be aware of because it will be an additional percentage that's tacked on in terms of expenses that are getting paid out of the property. Those are some of the syndication fees just to be on the lookout for. I'm happy to talk about other fees that arise on a transaction both during and after that can erode investor returns as well, even if they're not technically fees of the sponsor. So happy to go into that if you'd like, or we can take it in whatever direction you'd like to.
Yeah, let's talk a little bit more about those fees, either hidden or not hidden, that would erode investor returns. I mean, you spoke about some of the fees that are pretty standard, asset management fees, acquisition, disposition fees, refinancing fees, for example. What are some non-standard ones? What are some ones that maybe an investor should question or push back on?
Yeah. Now, hopefully, the investor can make this known to their sponsor as to certain things they want to negotiate. The investor can ask to see the loan documents as well. That's not unheard of, even though the sponsor tends to take the lead on reviewing and finalizing loan documents. There are a lot of fees that arise in connection with just simply closing the deal and closing the loan. One thing that probably a lot of people are aware of is usually if you use financing, which is common to complete an acquisition, the fees of the lender's counsel are going to be paid by basically by the borrower or by the purchaser. And that's fine on a smaller deal, where it's maybe a conventional lender where they may have form generated documents like Laser Pro, where some processor is basically populating those documents and simply has an attorney review them, because those fees will be substantially lower. If you get into more sophisticated financing like CMBS loan, that's where you have loan agreements that can easily be 100 pages long. And that's just one of probably a dozen or more documents that will be customized for the transaction, which basically means the attorney's fees are going to be multiples more than what you would expect from a standard conventional loan. There will also be various third-party reports and things like that definitely add up in terms of things like phase one, zoning reports, any other third-party reports that a lender may want to see. And so one thing that I usually recommend on that, whether it's a sponsor or an investor communicating this to a sponsor, is to request an upfront estimate of what those third-party fees are going to be, rather than getting sticker shock when they see the settlement statement and realize how many expenses are part of the transaction.
Is that usually either projected or in some type of pro forma that is, I don't know if it's required, but is offered by a sponsor?
You can, in connection with the term sheet or the commitment letter, you can request that from the lender. And sometimes they'll have something almost off the shelf that they can provide, but sometimes they may have to ask their providers to provide that. But it's fairly common, and borrowers will usually receive that, particularly if the lender wants to get the business. And the estimates will be non-binding, but at least it gives a ballpark budget to the borrower as to what they can anticipate in that regard. Some of the other things that you'll see with some of the more sophisticated loans are various reserves that are required to be maintained. This can be for countless number of issues. Oftentimes, it'll be for, in the commercial setting, there might be a tenant that's a sizable tenant in the building, and they have the option to terminate their lease in, say, 2 years or a year and a half. And for an issue like that, where it's very significant to the cash flow of the project, the lender is going to want to basically have a reserve in place in the event that maybe that tenant does not renew to basically protect their collateral, to protect debt service, and so on. And there are a number of other issues. There might be issues for deferred maintenance or capital expenditures where the lender will have their report. They'll have some analysis performed as to what needs to be done to this property. And depending on what that report says, sometimes they'll have to have a certain number of reserves set aside for that as well. And oftentimes, lenders may even, if you have favorable financing, they may actually advance the proceeds for those reserves, but that may be something where you are definitely paying interest on those funds, even though you're not really using it for daily operations of the property, but it's something, it's definitely a cost that you incur, and the lender is not advancing those funds for free. So you're being charged for those as well. Some of the other things you'll see is in leases, if there are future allocations for tenant improvements, leasing commissions, rent abatement, and any sort of concessions in favor of the tenant that might kick in after closing. Usually the lenders will have done a pretty solid review of the leases, and they'll probably want to have reserves for those as well. And it's not uncommon that they'll want reserves for maybe 125% of that amount, just to make sure that when those events occur in the future, that nothing is going to basically impair the viability of the project or impair the debt service. And so they're going to want to make sure their funds set aside for all of those. And so those add up, particularly again for some of the more complex loans, but they're all situations where you're going to be paying interest on those. So that's something that can basically erode the returns. And also, what I was mentioning in terms of the tenant costs, the tenant improvement costs, leasing commissions, that's one of those things as well that when you're drafting a purchase and sale agreement, that it's very clear as to how those expenses are allocated between the buyer and the seller. Usually it's the closing date can be the determination, but the parties do have the ability to negotiate a different deal than that if those are significant costs. So that's just something else to look out for. Some of the other things that hopefully turn up in your various third-party reports that as a purchaser you would perform. Hopefully, as you become more experienced, you learn to have very conservative estimates. You might set aside money for yourself, even if it's not lender driven, for some of the capital expenditures and taxes and insurance that you're likely to encounter rather than being reactive and paying those costs as they're incurred. It's prudent, it's conservative to basically forecast and anticipate those costs beyond what the simple debt service would be. So it's one of the things that can erode returns. And I think one other thing that comes to mind is depending on the purpose of the property, if it's something where you are a syndicator and you're going to have maybe a shorter hold period before you sell the asset or refinance it, just be very mindful of what your prepayment penalties may be, or if you're going to have to engage in a defeasance of the loan, because that can be expensive as well. And it's not a process everybody has gone through in terms of buying the replacement treasuries and just for your listeners that may not have dealt with the defeasance, basically, if the lender has forecasted a certain return from the loan that they're extending, if the borrower is going to pay that off early, that means that the projected return wouldn't come to the lender. So what they have to do is basically buy replacement collateral in the form of treasuries
Mhm.
to basically satisfy that return. So that's another mechanism That's different from a prepayment penalty, but it can be very expensive to do that to basically sell or refinance the property.
Right. So taking the mindset of the investor in a syndication, I'm thinking about legal red flags. First of all, what are the top, call it three different clauses in either the operating agreement or the private placement memorandum, the PPM, that investors tend to overlook but really shouldn't? Are there ones that come to mind?
Yeah, definitely so. That's one of the things that I tell sponsors early on is to not minimize the significance of documenting things correctly. I mean, that's
Hmm.
one way you establish trust by having solid documents to begin with that are very clear. And so I think I mentioned, just being very clear about disclosing what the fees are going to be, having very clear language in terms of what the hierarchy of distributions is in the waterfall distribution. So basically,
Yep.
who gets paid first? When do they get paid? When does the sponsor basically get their subordinate return or their sweat equity? And are there mechanisms where basically the sponsor doesn't get paid until the equity partners get paid or the limited partners get paid first? That's a key provision to have in there. One other thing that I would say does get overlooked is having exit strategies for investors. These can be clear and certain in terms of a certain event that's going to occur. Like if there's a sale, obviously they're getting their returns back and they're getting their initial capital back and that various hierarchy. So that would be one example of that. Bear with me 1 second.
Yeah, no worries. You mentioned a few things where they may be warning signs that a deal might be structured more to protect a GP than align with LP interests. And what are some of those warning signs that you've encountered before? I know a lot of times you represent the operator, the syndicator, sponsor, but from an LP perspective, are there warning signs that are fairly clear that a deal is structured maybe to protect the GP? I mean, I would imagine like waterfall, maybe the complexity of the waterfall or something else.
Yeah, I would definitely agree that's the case. If there's anything where their fiduciary duty is being waived, that should be a very large red flag to anybody that's investing with them. I'd say that's probably the single greatest issue. And honestly, although it's not uncommon to see it, language that basically says they get paid regardless. And
Mm,
I'd say
right.
probably the most significant one where people, again, when they're excited about a deal, tend to not really think it through is what if they're not performing? And to have clear definition as to what basically for cause would be to remove them. And one common example would be if they failed to pay preferred returns for maybe 2 consecutive quarters, that might be a triggering event where they have to submit a business plan for what they're doing to basically improve the situation, to improve cash flow. And sometimes they are truly doing their best and the market is just horrible and the prospects are horrible. But sometimes they'll sit on their hands and still collect their fees. And I've seen one example of this recently while the property continues to atrophy. And the investors are basically held captive in situations
Yep.
like that. And so basically having very clear mechanisms where the manager or sponsor can get removed if the property is being ridden into the ground. So the absence of that should be a red flag because then you're just at the mercy of the manager and hoping and praying that they know what they're doing. But one thing, and I regained my train of thought in terms of some of the provisions that need to be in operating agreements on exit strategies. And sometimes it's for a clear event, like I was mentioning, and sometimes there may just be an event like a death or disability of an investor or a bankruptcy of an investor. Or sometimes an investor just wants to disassociate because maybe the returns are not what they thought they were going to be, and they would just like to fairly peacefully exit the transaction and sell their membership interests in a clean way. And some of the mechanisms that you'll see for this, or you should see for this, again, it's surprising how often we don't see this, are some of the standard buy and sell mechanisms so that when notice is given by this investor that they would like to exit, How is their membership interest valued? How is it purchased? Who has to be notified? How soon does closing have to occur? And usually what we'll see is it will first be available to other investors because usually the parties, both the sponsor and the investors, want to have some restrictions on who the property can be sold to, excuse me, who the membership interest can be sold to, so that they're not inviting in random third parties as new
Right.
investors. And so that's a pretty common mechanism that you'll see. And usually there's a clearly defined valuation methodology for how that value is going to be determined. And sometimes you'll see other mechanisms where there may be a call or a put option or tag along or drag along rights where basically either the sponsor or the investors can compel the sale or purchase of the membership interest, again, to keep control of the project. So those are some of the mechanisms that people tend to not think about because again, they're hoping that the deal goes smoothly and they really haven't thought about what happens when things might go sideways or how you deal with that. So I just wanted to finish that thought from your earlier question.
Sure. To further that line of thinking, how negotiable are these protective languages in syndication documents? Is it usually take it or leave it, or is it dependent on, I guess, the equity contribution of the LP?
You nailed it exactly. Usually the willingness of the sponsor to negotiate it depends on how big the initial capital contribution is going to be from that lender. So sometimes we get no comments whatsoever to the operating agreements that we prepare.
Hmm.
But for more sizable investments, it's pretty common that they'll have a handful of comments. So that's pretty common. And then one thing, and I don't have to go too deeply into this, but sometimes if the investment is large enough where the investor wants to be able to avail himself to a 1031 tax deferred exchange,
Right.
sometimes you'll have to draft additional documents where you might still have some traditional investors that are housed inside the property owner LLC, but with the rev procs for the IRS and what's required, the person to avail themselves to a 1031, they have to actually own the property in fee simple through their own entity. And
Hmm.
so there are some exceptions. Some people use Delaware statutory trusts where it's a little bit more of a
Right.
flexible arrangement. But if you're not using a DST, you then have to draft all these tenancy and common documents and so on. And the
Right.
typical provisions are going to have to be restructured somewhat so that it doesn't look so much like a partnership that the IRS says that the 1031 is not viable. So that's one other factor that can arise if there's a large capital contribution.
Got it. Okay. And with tenancy and context, is that usually, and 1031s, is that usually more possible if there are a limited number of investors versus if there are over, call it 20 or so? It might be not feasible to get all the investors on board onto the tick.
I would say it's easier to document, and if you have less investors involved, it's more likely to actually be like a co-ownership arrangement.
Right.
What we have oftentimes seen is you may still have property owner LLC and then tick investor, or basically the two co-owners of the property. You might
Okay.
have that, but you might have like those other 20 investors in the property owner LLC, and you just have the tick owner over here by himself with his own entity. So you can still structure it without having to have 20 tenants in common. And that used to be the norm in the not too distant past. If you go
Hmm.
back
Okay.
20 or more years, you'd have a lot of transactions where there were basically like dozens of tenants in common. That's a bit cumbersome. There are certainly easier
Right.
ways to structure that, particularly if you only have a few folks that really care about the 1031 aspect.
Got it. Okay. If you were to give investors a non-negotiable checklist item, or maybe two items or so before they actually are pull the trigger and wire the funds, what would those be? I know there's probably a host of them, but
Yeah, I would say really for any investor, not just the larger ones, definitely have mechanisms where there are approval rights for certain key decisions. Although the sponsor is going to want to have almost absolute authority to handle the business affairs of the LLC, there should be certain things like sales, refinances, and so on, that at least a certain percentage of the investors have to approve because they want to be able to have some control over what happens to their investment. The other thing, and again, we don't really see this as often as we should in operating agreements, is to have some reporting obligations, some affirmative obligations by the sponsor to basically submit financial reports that could include anything from the net operating income, the debt service, what reserves are in place, what the cash on cash return is, and no less frequently than I'd say quarterly to be
Hmm.
getting those reports. So they just have a snapshot of how things are going. And I would say that's good advice, regardless of whether things are good or bad, just to have that ongoing piece of information as to how their investments going. I think we talked a little bit about just having clearly laid out waterfalls. And I know we've talked about capital calls as well. One other thing that we tend not to see, but might not be a bad idea, is to also have designated in perhaps the operating agreement who the investor representative could be that could interface with the sponsor regarding certain key decisions, because it may be a little too cumbersome to have 35 different investors interfacing with the sponsor. But maybe if they have one liaison that can address these issues and report back in a more efficient way to the other investors, that can be helpful as well. And then I think really one of the last things that's significant that investors can insist upon is to have a reputable CPA that basically is
Yep.
preparing the books for any audits, annual reviews as well, because you just want to make sure that you have a credible third party professional that's preparing that information and those documents as well. Trying to think if anything else comes to mind. And then probably one of the last things that's would be helpful, and I think I touched on it before, is having a provision where basically you can remove the manager for cause, what the criteria is for that, what the mechanisms are for that. And that's actually something that really benefits both the sponsor and the investors, is there's a little bit
Hmm.
more clarity as to what constitutes adequate performance. What can the sponsor do to improve the situation? And if they're not being diligent in doing so, how can they be removed and have a replacement manager appointed or elected?
Yeah, I like that last point. I don't see it as often on operating agreements as I would probably like, but I love that concept. With switching gears a little bit, talking about the market and kind of the regulatory environment, we know interest rates are where they are. They may be coming down a little bit, slightly tighter credit markets. How have you seen syndicators, operators, sponsors adjust their deal structures? And maybe does that create any risks for LP investors?
I haven't seen too much adjustment in the deal structures. What I'm honestly seeing is there's more optimism.
Hmm,
Um,
right.
and there's still, this whole time they've been looking at deals and trying to make deals work, but they're just not quite there. We're still working on some acquisitions. We have a few syndications in the works, but it certainly was not as robust as it was maybe 3 years ago.
Right.
But so we haven't really seen, unfortunately, I wish I had better news for you on that one, but we just haven't seen too many adjustments in their model or their deal structure to basically be doing new deals. And a
Got
lot
it.
of them are doing, I would say, damage control, or if you just want to call it kind of housekeeping and maintenance with their lenders to try to negotiate better financial terms and covenants, and as well as conjoining that with capital contributions to keep certain assets viable. So they're not so much in acquisition mode, but they're basically working with their lenders as well as their investors to make sure they're not forfeiting any of the collateral or the assets. So that's kind of more what we're seeing currently.
Got it. Okay. As a side question I had around maybe some of the syndications operations that are struggling and maybe are looking to sell, are there any, from an investor perspective again, we know that there are funds that are looking to acquire those assets. If an investor is interested in investing in those funds, is there something that those investors should be looking out for, paying attention to? Obviously, those assets are struggling in the first place. Maybe it's because of It's because of the various nuances of how the operating agreements were structured or the financial agreements were structured. But anything that jumps to mind as to what an investor should keep in mind.
Yeah, if it's something where maybe there's a distressed asset fund, that if I'm understanding your question, where
That's
they're
right.
potential evaluating whether to evaluate or invest in that, the one thing that I would make sure is very clear is depending on which state that asset might be, making sure that they definitely have engaged local counsel for any state-specific nuances. Because it's
Right.
not uncommon that the structure you'll see for those distressed asset funds, they might have some relationship with the lender where maybe some sort of short sale is being negotiated, but it's not uncommon that they'll be purchasing the promissory notes from existing lenders.
Right.
And with the likelihood that they're probably going to be foreclosing on those properties. And so a big part of that is just making sure that the promissory note has been validly assigned and that you're having an attorney look at that to make sure it's in compliance with the that particular jurisdiction, but also making sure that any collateral documents like a mortgage or a deed of trust, as they call it in some states, are in proper form so that when foreclosure does occur, so that the new owner acquires a title to the asset, that foreclosure goes smoothly. And so there are no procedural hiccups with that. So making sure that basically those documents are complete and compliant with local law is going to be important. And having some idea too as to which jurisdiction is going to have judicial foreclosures versus foreclosures like they have in Virginia, where we actually don't have to have a judge validate it. You can actually, if you have everything
Hmm.
properly secured and you have your deed of trust recorded in the land records, which again is basically your mortgage instrument, and you've sent out the notice, you've met all your obligations as the lender in terms of giving them opportunity to secure and so on, you're able to foreclose basically on the courthouse steps without having
Hmm. Okay.
basically to get a judgment first.
Right.
Not all states have that. Some you can't foreclose. Some states you can't foreclose without getting a judge to sign off on it. But that's just another thing to examine because that will definitely affect the alacrity and how quickly the asset can be obtained, depending on how protracted the foreclosure process is.
Speaking of regulations, how have you seen regulators treat syndications in the context of like online platforms or crowdfunding models where they would list those syndications on those platforms? Any special considerations on how regulators would treat that?
Yeah, there's certain things where I always advise clients that it's worth doing any filings that are required. Some of them want to minimize legal costs and so on. And I always say that's a bad
Right.
idea because even if you think that you fall safely with, under like a 506 exemption, there still are filings that you can do and should do because all it takes is for one deal to go bad or to have one upset investor, and then they can easily point to something that you failed to do procedurally.
Hmm.
Um, and so that's one thing that I recommend is when you close the deal, basically do the online filing that's pretty easy and inexpensive to do so that you've at least complied in that regard. In terms of before closing occurs, when clients ask us, okay, we're thinking of raising money for this, how do we approach investors? We are pretty conservative in what we tell them to do. We make sure that they understand the difference between accredited versus sophisticated investors, that they understand also that it's probably in their best interest to not be doing any sort of mass solicitation, although there's some exceptions to that. It's generally not
Hmm.
good policy. You really, particularly on your earlier deals, you want to start with people that you know. And we always use the expression friends and family because
Right.
it's not only maybe a little easier to raise money with people who are familiar with you, but if you have issues, theoretically, it might be easier to actually explain those issues to somebody that you already have some track record with. So just being very cautious about the nature of solicitations and again, just being very transparent with all of your preliminary investor materials and making sure everything's disclosed. And we always say to put the disclaimers in there in the whether it's the PPM or the subscription agreement just to make it very clear to investors that they can lose everything. And that's something that regulators would want to see too, because the whole idea is to protect investors and keep them from possibly losing everything or enough that it would be ruinous to them. So just being mindful of that. But again, even if you have those disclaimers, as I was saying before, sometimes the optics of the situation, it's best to act like you have almost unlimited liability and that you truly care about your investor's contribution, because that will definitely preserve your reputation in the long term if you can go above and beyond the bare minimum in that regard.
Got it. Speaking of liability, and this is a personal interest question of mine as well, E&O insurance, umbrella insurance, what can a what can an operator do to protect themselves from either not necessarily fraud, because they won't necessarily be able to protect themselves from that, but from general omissions. Errors and
Yeah,
omissions, obviously, you know. Yep.
yeah, they can take a staggered approach to that. I mean, usually they will have a provision in their operating agreement saying that the manager is not liable absent fraud or possibly gross negligence. That's one layer of protection, but I think it would be good practice for them to talk to their insurance consultant about any sort of insurance for officers of a company or principals of a company, just as an additional layer of protection and how much a premium would be for that. And some clients I have basically a blanket policy, and every time they do a new deal, basically that new LLC is there's an endorsement where basically that particular LLC and their involvement with that LLC is also covered under the policy rather than getting a brand new policy every time. So that's something I would recommend as well. And usually if you can couple together a couple remedies like that, you can better insulate yourself from liability.
Got it. Okay. AI. So, as an investor, taking it from the investor perspective, trying to assess kind of risk and whether I want to invest in a particular deal. ChatGPT is there, other platforms, other LLMs are now available. They can use some of that to do some of their analysis. One question I had typically before all these LLMs existed is like, what are practical steps investors can take to improve their legal literacy in syndications? And now you can feed all the deal documents, the PPMs and like into an LLM like ChatGPT and the like to ask what risks are more than the standard risks that an investor would take. What's your stance on AI and using AI to do those level of analysis? And generally, like what can an investor do to improve their both legal literacy as well as maybe take the first step for maybe I would almost say reputable legal help, not necessarily quite there
Right.
yet. What, and so generally, like AI, what's your stance on AI?
Yeah, it's a really interesting tool, particularly if you want to educate yourself on a particular topic. In terms of using it to basically analyze the document and maybe advise them of risks or deficiencies or ambiguities, it could probably be helpful for a first pass. I would use it though, if someone does use it more in a supplementary way, because it does make mistakes.
Correct.
It tends to highlight what it thinks is important, but it might not be something that's specific and critical to that deal. It might just be sort of a general concept. So it doesn't necessarily address everything. And it doesn't necessarily catch everything that just an independent set of eyes would catch. But I wouldn't necessarily discourage it. But again, I think it would be ancillary to having independent counsel review something. But it might
Hmm.
be something that at least gives you a big picture idea of what the document says and maybe helps you refine some of your questions and concerns when talking to your attorney. But yeah, I'd usually recommend still having independent counsel look at something because there just might be something that AI doesn't catch that experienced counsel would.
Got it. Okay, thank you for that. And I think I understand or know the answer to this, but should an investor always request independent counsel to look at deals as they're analyzing whether they should invest?
I would say generally, particularly on the first deal, the only time where maybe counsel might not be as critical as if they've invested with this sponsor before and
Mhm.
they've gotten a red line of the documents, a red line comparison that shows all the changes that have been made. And if it appears that the only changes that have been made have to do with describing the property and maybe some deal specific just business terms, They probably can lean a little bit less on their counsel on that. But if you're doing deals with different sponsors and the documents are not homogeneous and change quite a bit from deal to deal, I would still recommend getting counsel for those. It would just be
Got it.
for
Okay.
more simple, repetitive transactions
Right.
is where they might be able to get away with less legal
Right.
fees.
That makes sense. Okay. I know we're at the top of the hour, and two questions I always ask guests. One is, if you were to look 15, 20 years back when you first started, what advice would you give to a younger Richard?
The younger Richard. Yeah, I think for the short downturns, probably having a practice in foreclosure would have helped during the great financial crisis, because then you'd quickly pivot
Right.
to a different
Right.
practice area when transactional volume slows down, or definitely having a lot more of a practice in just loan workouts and things along those lines. I think that would certainly be helpful. And I would say probably, although we have a pretty diverse mix now, in terms of clients, that's evolved over time. So we were very retail heavy when we first started. And then during the GFC, I mean, kind of throughout and not long after, multifamily was
Yep.
humming along. And we didn't
Yep.
have many multifamily clients back then. We do
Hmm.
now, but that was just
Right.
another one. Or having it's you never know at a given point in time what sector is going to be hot. We've always done a little bit of industrial, but had not forecast how hot industrial would be right after, during and right after COVID. So that was interesting as well. But I would say just having a wide client base to basically weather the peaks and valleys, excuse me, of the various environments so that you have plenty to keep the lights on during those years where there's less transactional volume. But then when things ramp up, then you're having banner years and so on. So basically keeping things diverse, not being too pigeonholed, and not being afraid to learn new things as well. I think that's critical. And those are pretty much all that come to mind right now.
Okay. Okay. Thank you for that. And then the other question is, how do you give back to your community, or how does Woods Rogers give back?
Yeah, they are very good about sponsoring certain events. One that comes to mind, there's a group in our area called Eggleston Services that basically provides vocational training for adults with special needs. And so they're always very supportive of their endeavors. And one of my partners and I have been on their capital campaign to basically raise funds for additional facilities that they need. One of the things I do personally is there's a group called Team Hoyt, and in my area it's Team Hoyt Virginia Beach. They're basically are maybe 12 chapters of that. And it all started dozens of years ago with a man named Dick Hoyt, who unfortunately has passed away, and his son Rick Hoyt, who passed away fairly recently. And Dick Hoyt was an excellent athlete. He had a son, a nonverbal son, who was wheelchair bound, was not ambulatory, and he wanted to find a way to share his love, particularly for running races, with his son. And
Hmm.
over time developed these racing chairs, teaming up with certain manufacturers. And he ran, I think, hundreds of marathons, it seems like. I think he did the Boston Marathon
Oh, wow. Yeah.
dozens of times, pushing a chair. So
Right.
qualified for
Yep.
Boston, pushing a chair. And
Oh, wow.
his mission of inclusive racing is it certainly has a lot of appeal to a lot of people. And it's been something very rewarding that I've gotten involved in the last 10 years or so. And most of us that go out there to push these racing chairs, and most of them are special needs children that are in the chairs, we would be out there running anyway. And but it's one of those things that once you get involved in this, it just adds a layer of meaning and motivation to every race we do. The kids love it. It's a chance for them to get outside and experience something they wouldn't experience. They get to hear crowds cheering for them, shouting their name. The families get very into it as well. And just getting to know the families as well is incredibly rewarding. And having done it 10 years, I can't really picture myself doing a race any other way. Sometimes
That's
people
great.
will say, "Oh, it's so great that you give back." And it sounds almost unusual to me because it is so fulfilling and rewarding. It doesn't no aspect of it seems like service to someone else. I think a lot of people have no idea what they're missing by not being a part of something like this. So it's something we do most weekends, and just so thrilled that I found it and kind of amazed I didn't know about it until about 10 years ago. But no, it's definitely something that is very fulfilling for us.
That's fantastic. Thanks for that information. And thank
Certainly.
you very much for the great conversation, Richard. How can investors find out more information about both you and your firm and get in touch with you?
Okay. My email address, if they want to reach out to me, and I'll say it and then I'll spell it, it's richard.crouch at woodsrogers.com. Probably the easiest way to get a hold of me. And Richard is like it sounds. Crouch is like crouching tiger, Crouch. And then Woods Rogers, both of those are plural. So Woods with an S, Rogers with an S.com. And I'll give you my direct dial so that you have that. The area code is 757 446 8684, and I will get that message and get back to you very quickly. But if you want to read more about either me or our attorneys, our website is pretty easy to access. It's just woodsrogers.com, www.woodsrogers.com. And you can read about all the various practice areas and attorneys at our firm.
Okay, perfect. We'll include all that information in the description of this particular episode as well. Don't forget to like and subscribe to our podcast on whichever platform you're listening to make sure that we can continue bringing you the best educational content like this one. Thanks, everyone. Thank you, Richard. And until next time, keep learning to invest for generational wealth.